Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. One of my most popular YouTube videos is the one I published a year ago on December 11th, 2021. In the video, I had made a prediction. I had predicted that out of the top 500 companies on the BSE by market cap, almost 70% could witness a decline over the next 1 year. Yes, that's correct. I had predicted that nearly 350 out of the top 500 companies will fail to give positive returns in the year 2022. Now we are coming to the end of 2022. Therefore, what better time than now to find out whether my prediction has come true? Did 350 out of the top 500 companies by market cap really suffer a decline in the current calendar year? Well, let's find out. So in the first half of 2022, a whopping 81% of the top 500 stocks suffered a decline in their prices. 403 out of the top 500 stocks gave negative returns. So my prediction was bang on. In fact, the performance of the 500 stocks was even worse than my prediction. Not 70%, but a full 80% stocks fell in the first half of 2022. However, the situation reversed in the second half. Markets witnessed a recovery and only 21% of the stocks ended in the negative in the second half of 2022 until December 12. This means that in the second half of 2022, 80% of the stocks gave positive returns and only 20% ended in the negative. Thus, we have two contrasting numbers. In the first half, 80% of the stocks were negative, and in the second half, 80% of the stocks were positive. The last row in bold letters is the data for the full year. For the full year till December 12, 274 stocks out of the top 500 stocks by market cap have given negative returns. In percentage terms, this amounts to almost 55%. More than half the stocks have fallen in 2022, while the remaining 45% have given positive returns. So what do you make of my prediction? Would you call it a success, or have I failed? I think I'd like to call it a success, as more than half the stocks are down in 2022, and I was also bang on for the first 6 months of the year. It was only in the second half that the markets took off, and still only 45% of the stocks managed to give positive returns. Now, if you think my prediction was correct and are interested in knowing how I made it, here's the secret behind my prediction. Take a detailed look at this chart. On the horizontal axis are the calendar years from 2011 to 2021. I have divided the year 2020 into two different time periods. 2020A is the period between Jan and March when the Sensex had a big crash due to the coronavirus pandemic, and 2020B is the period between April and December where the market quickly recovered. So the horizontal axis consists of calendar years from 2011 to 2021. The vertical axis denotes the percentage of stocks that ended in the positive in a particular calendar year. Like for example, 9.4% stocks out of the top 500 stocks by market cap ended the year 2011 in the positive. In 2012, a whopping 79.2% stocks out of the top 500 stocks closed in the positive. In 2013, only 29.6% stocks closed in the positive, and so on. The green bars are the years where 80% to 90% of the stocks closed in the positive. In fact, 2020B, that is period from April 2020 to December 2020, a huge 97.2% stocks closed in the positive. Similarly, other green years were the years 2012, 2014, 2015, 2016, 2017 and 2021. Now I have taken 50% as the cutoff for the bars to be colored green or red. If the number of stocks that ended up in the positive are more than 50%, then green, otherwise red. I have colored the bar for the year 2016 as green because it is very close to 50%. Likewise, the red bars are the years where majority of the stocks closed the year in the negative. 2011, 2013, 2018, 2019 and 2020A are the periods where the top 500 stocks put up a poor performance and a vast majority of them witnessed a decline during the period. Well, I have given one more data point. The data point is at the bottom of the slide. It is the Sensex PE ratio at the start of each calendar year. So the first PE ratio from left to right is 23.6x. This means that at the start of the year 2011, the Sensex was trading at a trailing 12-month PE ratio of 23.6x. At the start of 2012, it was trading at 16.4x, 17.5x in 2013 start, and so on. Now look at the PE ratios at the start of 2020A and 2020B. The Sensex started the year at a PE of 26 times, and then because of the huge coronavirus crash, the PE collapsed to 17.8x at the start of 2020B. That is the start of April 2020. Now if you observe carefully, there is a pattern to this chart. The green bars are usually associated with a low PE ratio at the start of the year, and the red bars are associated with a high PE ratio at the start of the year. If you look at the green bars, the Sensex PE ratio is mostly below 20x except for the year 2021. And if you look at the red bars, the Sensex PE ratio is mostly greater than 24x except for the year 2013. So here's the conclusion that can be taken away from this chart. If the Sensex PE is below 21x at the start of the year, then there's a strong chance majority of the stocks in your portfolio can go up in the next 12 months, provided your portfolio comprises mainly of top 500 stocks by market cap. If the Sensex PE is greater than 24x at the start of the year, then majority of the stocks can go down in the next 12 months. And when the PE ratio is between 21x and 24x, then perhaps one should expect the ratio to be roughly 50-50. Now let me repeat that again. If the Sensex PE multiple is below 21x at the start of the year, then there's a strong chance that a large number of top 500 stocks can go up in the next 12 months. Likewise, if the PE multiple is higher than 24x, a large number of top 500 stocks can go down in the next 12 months. And this is exactly what had happened in the chart we saw earlier. When the Sensex PE was below 21x, majority of the stocks during that year closed in the positive, and when the PE was above 24x, majority of the stocks closed in the negative. Now do you know what was the PE ratio as of December 31, 2021 or even December 10th, 2021 when I published the video? Well, it was around 28x. Now since this is significantly more than 24x, I had made the prediction that majority of the stocks could go down in 2022. In fact, I had pegged the number at 70%. So instead of 70%, almost 60% of the stocks have gone down in 2022 so far. I hope you got the secret behind my prediction now. It's very simple, isn't it? All you have to do is figure out the Sensex PE ratio at the start of the year, and based on that, you have to predict the percent of stocks that can go down the next year. Now, have you wondered what does the PE ratio of 21x for the Sensex indicate? Well, it is the average PE ratio of the Sensex over the last 30 years or so. Historically, Sensex has traded at an average PE multiple of around 21x. Therefore, when the PE ratio falls below 21x, it is usually a good time to invest in the stock market, and when it goes significantly higher than 21x, that is 24x or more, it is a good idea to reduce exposure to stocks. So if you're looking to put a lump sum amount in the stock market, it could be a good idea to invest the majority of this lump sum amount if the Sensex PE is below 21x, and invest only a small portion if the Sensex PE is greater than 24x. If it is between 21x and 24x, then you can perhaps invest only half of the lump sum amount. Now, what is my prediction for 2023? How many stocks from an average investor's portfolio can go down in 2023? Well, the Sensex PE, as I record this video, is in the region of 23 times to 24 times. This means that the Sensex is not very expensive, but it is not very cheap either. Therefore, a good number to bet on given the current valuations would be 50%. If the past is any indication, there's a strong chance that 40% to 50% of the stock in an investor's portfolio could go down in 2023. Let me repeat that. I believe given where valuations stand at the moment, there's a strong chance half the stock in a typical investor's portfolio could witness correction in 2023. Now, is there any other use of this data point besides the ability to predict what percentage of the stocks in the portfolio can go up or down in 2023? Yes, there is. We invest in the stock market because we want to beat the benchmark index by at least 5 percentage points per year. If we can't beat the benchmark index by 5 percentage points, that is, if we don't earn 20% per annum when the benchmark is giving 15% returns per annum, we might as well invest in an index fund. Our efforts are of no use if we can't earn minimum 5% per annum more than the benchmark index. So how do we earn this extra 5%? Well, there are a lot of ways of doing this. One of the methods that I prefer is switching allocation between bonds and stocks once every 12 months based on the broader market valuation. So if the Sensex is trading at a PE multiple of below 21x, one can have 75% allocation to stocks and only 25% allocation to bonds. And likewise, if the Sensex is trading at a PE multiple of greater than 24x, one can have 25% allocation to stocks and as much as 75% to bonds. Between a PE of 21x and 24x, one can have 50-50 allocation. Let me repeat that. Less than 21x, we can have 75% stock allocation. Between 21x and 24x, we can have 50% allocation. And greater than 24x, we can have only 25% stock allocation. Please note that at no point in time the allocation to both stocks as well as bonds go below 25%. This is the minimum that should be held in each asset class with no exception. So now there are two uses of the Sensex PE ratio. We can use it to predict what percentage of the stocks can go down in the next calendar year, and we can also use it to fix the allocation between stocks and bonds. But is this method guaranteed to help us earn the extra 5% returns per annum? Well, there are no guarantees in investing. There is no method that will guarantee a 5% extra return over the long term. However, this toggling or switching of allocation between stocks and bonds will allow you to do the right thing from a long-term perspective. It will allow you to reduce exposure to stocks after the market has gone up a lot, and it will also allow you to increase exposure to stocks after it has fallen a great deal. In other words, it will allow you to buy low and sell high. Now, majority of the investors are not even able to do this. They usually get interested in stocks after the market has run up a great deal and lose interest after it has fallen a great deal. Therefore, this method of switching between bonds and stocks at least allows you to get interested in stocks after the market has fallen and exit some of your holdings after it has gone up a great deal. Thus, if you keep doing this with discipline and invest in fundamentally good companies at decent valuations, there is a strong chance you will earn those extra 5% returns over the long term. Let me know what you think of this approach. And please do not forget to send in your feedback in the form of likes or comments. Until next time, goodbye and happy investing.